All right, we are going to do another one now. We're going to do a full cash flow statement. We're going to do 3.42. Where's 3.42? There you go, 3.42. Required cash flow statement for the year ended 28th of Feb 20.3. So, when you do a cash flow statement, you are trying to get to one particular figure called net change in cash and cash equivalents. That is the whole thing of the cash flow statement. You can either go from top to bottom or bottom to top to get there, but you have to do it both ways. Bottom to top, as I call it, is where you take your cash and cash equivalents at the beginning of the year and you minus your cash and cash equivalents at the end of the year. That gives you the net change in cash and cash equivalents. That figure must be the same going the other way, which is when you take your cash flow, your cash effects of operating activities, plus or minus your cash effects of investing activities, plus or minus your cash effects, cash effects of financing activities. So let's look at a cash flow statement, and you'll see what I mean. Here is our net change in cash and cash equivalents figure here. Now we could go bottom to top, which is this way, or I don't know if you'd call it bottom to top, but that's what I call it, which is where you take your cash and cash equivalents at the beginning of the year minus your cash and cash equivalents at the end of the year. Or you can go, as I call it, top to bottom, which is where you take your cash flows from operating activities plus or minus your cash flows from investing activities plus or minus your cash flows from financing activities to get your net change in cash and cash equivalents. Now let me be clear, you have to do both ways. But when I say you can do it this way or that way, I mean you can start with the cash and cash equivalents way, the bottom up, or you can start with the cash flows from operating, investing, and financing activities, which is top down. But you have to do them both. The point I was making is you don't necessarily have to do it in a particular order. You can do the bottom up way first and then the top down way second, or you can do the top down way first and then the bottom up way second. But either when you do both of those ways, you must end with the same figure in of net change in cash and cash equivalents. If you do not get the same figure, you have probably made a mistake in the top down way. That is, adding together your cash flows from various activities. All right, now that we have established the basic kind of approach, we are going to start top to bottom. That is, we are going to start by getting our cash flows from operating activities. In order to work out our cash flows from operating activities, we need four things: cash generated from operations, interest paid, dividends paid, tax paid. Let's start with cash generated from operations. There's quite a lot that goes into that, so we have a note for it. Note 1. Let's go to Note 1. Here's Note 1, Notes to the Cash Flow Statement. Note 1 has quite a long and laborious name. The name is Reconciliation between Profit Before Taxation and Cash Generated from Operations. It's quite a laborious name, I know. Now, what we are doing here essentially is or I should rather say, this note to the cash flow statement can be split into two parts: getting to our operating profit before changes in working capital, and then adding or subtracting our changes in working capital. And the answer will be your cash generated from operations. Now, The first part, getting your operating profit before changes in working capital, is quite easy. We take our profit before tax, we add back depreciation, and we add back interest expense. So let's go to the information that we are provided with. Here is our statement of comprehensive income. Let me just erase this that I wrote earlier. We don't need that right now. All right, here is our income statement. We have net income after tax. Is that the one we need? No, it is not. We need the net profit before tax. We take that net profit before tax, we add back the depreciation that we minused earlier, which is over here, and we add back the interest expense that we minused earlier in this statement, which is here, 14,000. That is how we get our operating profit before changes in working capital. And let's look at it here. Oh wait, am I looking at the right thing? This is 3.42. That's the right one. Oh, whoopsie. Did I look at the wrong one? No, this is the right one, 3.42. How about this? What's this? Oh, this is 3.44. Whoopsie, sorry. Let's go back to 3.42. Here it is. Right, so here's our reconciliation note. Profit before interest and before tax is 99,000. We add back our depreciation and our interest expense, and that gives us our operating profit before changes in working capital. Now we have to add or subtract our change in working capital. There are three types of working capital. There's inventory, there's I don't want to say debtors, but rather trade and other receivables, and trade and other payables. So they've got debtors and creditors. That's not quite correct. It should be trade and other receivables and trade and other payables. So let's find our changes in working capital. So we're going to go to the statement of financial position, or balance sheet, for this part. First, we look at our inventories. Did our inventories go up from 20.2 to 20.3, or did it go down? Well, it went down, which means we've sold more inventories than we've purchased, which means that change in inventories is a cash inflow. So we don't put it in brackets. 5,600. 5,600, there it is. It's a decrease in inventory. 5,600, a cash inflow. That's why it's not in brackets. Now let's do our trade and other receivables. They have not given us the note for trade and other receivables, so we're just going to use the figures they've given us here. Trade and other receivables, which is money that is owed to us, has gone up. Now, if trade and other receivables went down, that means some of the money owed to us was paid to us, which means that money would be a cash inflow. Therefore, if the trade and other receivables is actually going up and not down, we must consider it a cash outflow. So we will put it in brackets. In this case, it was 8,600. Let's go to our marking guidelines. There's 8,600 in brackets. An increase in trade and other receivables. Now we want to look at our trade and other payables. Let's just make sure I still have volume here. Yes, I do, it looks like. So we're going to our trade and other payables now. Note 4 to the balance sheet. Now we have to be careful here, because trade and other payables might have things that don't go into this part of the cash flow statement. Let's look at note 4 and I'll show you what I'm talking about. Here's note 4, trade and other payables. It has trade creditors. That does go into this part of the balance sheet, of the cash flow statement. It has income tax. Oh, that does not go into this part of the balance sheet, and I'll show you why in a moment. Dividends does not go into this part of the balance sheet. Expenses payable, it can, depending on what expenses are payable. For example, if you owe rent to someone. But in this case, it's an interest on loan. Interest on borrowed funds does not go into this part of the cash flow statement. And I'll show you why it doesn't. Remember that after we've done this reconciliation note, this cash generated from operations figure will go into the cash flow statement. So it will go under the cash flows from operating activities. You see, there it is. Then, as separate lines, we have interest paid on borrowed funds, dividends paid, and taxes paid. So these interests and dividends and taxes are listed separately from our cash generated from operations. Therefore, we cannot include those figures in the cash generated from operations, or we'll be including them twice. Right? We'd be doing it once in the cash generated from operations, and then again when we do interest paid, dividends paid, taxes paid. We don't want to duplicate the information. That will throw off the accuracy of our cash flow statement. So we're not going to do it twice. We will do it later. So we'll do it here and here and here. So in this part, the reconciliation note, when we're doing our changes in working capital, and we're looking at our trade and other payables, we will not include income tax things, or dividends things, or interest on loan things. So what's left here in these trade and other payables? There's only trade creditors. The trade creditors went up. That is to say, we owe more money at the end of the year. Now let's think about this. If I owed less money at the end of the year than I did at the beginning, that would mean that I paid back more money than I borrowed. Right? I paid my creditors more than I borrowed from my creditors. But in this case, I borrowed more than I paid. Right? Because my trade creditors went up. So if we think of the other way, that if we had paid more than we had borrowed, that would mean that our cash flow went down. That is, if our books reflect that we had paid some creditors throughout the year more than we had gained creditors, that means there's an outflow of cash. Which means that if our trade creditors goes up over the year, we must regard it as an inflow of cash. So it will not be in brackets. This will be something like, what's this, 11,000? So, I can't do this in my head. Now at 10 p.m. at night, and it's I'm sleep deprived. As you know, I've got a newborn. I can't think very clearly. So. Let's just look at what the marking guidelines gives us for that figure. It is 12,200. It's not in brackets because our trade and other payables went up. If it went down, we'd put it in brackets. If it went up, no brackets. All right. Now we can say the 5,600 minus the 8,600 plus the 12,200. And we get changes in working capital of 9,200. Now that we have this figure, we can take our operating profit before changes in working capital that we worked out earlier, this figure, and we can add the 9,200 that we just worked out. And that will give us our cash generated from operations, 131,200. Now, that 131,200 will be the first of the 4 lines for cash effects or cash flows of operating activities. Here is our cash flows from operating activities up here. It's the first of the three cash flows that we're working out. And there are these four things, 1, 2, 3, 4. And we've just finished working out the first one. We used note 1, that reconciliation note. And the cash generated from operations was 131,200. Now we have to minus the interest paid for the year. Sometimes that's as simple as just going to your income statement. Where's the income statement? And looking at what your interest paid for the year is. There, interest expense, 14,000. But sometimes we owed some interest expense from the previous year, and sometimes we owe some interest expense at the end of this year, in which case we have to add and subtract those figures. We have to do it in this activity too. So we have an interest expense of 14,000 Rand for the full year, for this year. But at the end of the year, if we look at our trade and other payables note, at the end of the previous year, we owed 2,500 in interest expense. We would have paid that first, so we definitely paid that this year. We also owed 3,000 at the end of this year, which means we have not yet paid that interest expense. So we're going to take our total interest expense for the year, add the interest expense from last year that we didn't pay, and minus the interest expense from this year that we didn't pay. And that will give us a total interest expense of 13,500, or rather a total outflow of cash for interest expense of 13,500. Let's look at it in the marking guidelines. 13,500 interest paid. Right, the 2,500 from the beginning of the year plus the 14 for this year minus the 3,000 we hadn't yet paid, 13,500. Now let's do dividends paid. We don't have to do it in brackets here because we have a note to the balance sheet here. I mean a note to the cash flow statement. Let's go down to the note to the cash flow statement. Or rather, let's first go to our balance sheet so that we can see what information we have to put into the note to the cash flow statement. Where's our balance sheet? Here it is. Here it is. No, these are notes to the balance sheet. Here's the balance sheet. Okay. We are looking at, what are we looking at? Dividends, right? Is it dividends next? Yeah. Let's go, where's it? Yes. Dividends is the next one we're doing. Number 3, dividends. Let's check I still have sound here. Yes, I do. That's good. So we're going to our balance sheet. Here it is, statement of financial position. That's another word for another name for the balance sheet. And we're going to look at our dividends. Now, in order to see our dividends, we need to look at 3 figures. We need to look at what dividends did we owe from last year, what dividends do we owe at the end of this year, and how many dividends altogether did we issue this year. Let's start by looking at all the dividends that we declared this year, or paid, declared, whatever. However you want to phrase it, all of the dividends that we told our shareholders they would get this year. So, in the middle of the year and at the end of the year together, we told them they would get 40,000 rands worth of dividends. We can see it in the retained income note to the balance sheet. Note 3. There's dividends declared and paid. 40,000. That is for the whole year. But at the end of the previous year, look at our trade and other payables, we had shareholders for dividends of 19,000. That is, we owed 19,000 Rand to our shareholders at the end of the previous year. That we owed it for dividends that we had declared to them. So we have to pay that this year, or we did pay it this year. Also, at the end of this year, we still owed our shareholders 24,000 Rand of dividends. That amount we have not paid. So we're going to do a similar calculation as we did for the interest expense. We're going to say our total dividends paid and declared for the year, 40,000, plus the dividends that we owed at the end of last year, minus the dividends that we have not paid from this year, that we will have to pay next year, 24,000, and that will give us some amount. Let's see, 40 plus 19 is 59, 55, 35. So that'll give us 35,000 Rand outflow of cash for payment of dividends. Let's look at it here. Dividends paid, the note to the cash flow statement. Amount owing at end of previous year, 19,000. Dividends paid and recommended, 40,000. That's the total dividends for this year. Amount owing at the end of the current year, 24,000. You sum those and you get 35,000, which is what we also calculated together on the other on the question paper, which is here. See, there it is, 35,000. So we take that 35,000 and we put it into our cash flow statement. Where do we put it? Where's the cash flow statement? Here it is. Dividends paid, 35,000. It's an outflow of cash, so it's in brackets. We have to do the same thing as we've just done for interest expense and for dividends paid. We have to do the same thing for taxes paid. So let's go to our information here. Our total tax for the year was, let's see, where's our taxes? Let's go to our income statement. That's usually where we see tax. Well, it's always where we see tax. Income tax, 45,600. All right, so we know that our total income tax for the year was 45,600. We have to add whatever was left from the previous year and minus whatever is, so right here, previous, add whatever's from the previous year and minus whatever's left at the end of this year. I'm going to say leftover. I'm not choosing good words here, but I hope you know what I mean. We have 45,600 of taxes total for this year, plus we have to pay a bit from last year, and we have to take out whatever bit we still owe at the end of this year to SARS. Now we must be careful with this, because at the end of the previous year and at the end of this year, it is possible that we owe nothing, and that in fact SARS owes us. If that were the case, we would minus here, and we would plus here, if SARS owes us. But if we owe SARS, which is the normal situation, then we have to plus the previous year's stuff that we owe, and minus the end of year stuff that we owe at the end of this year. Now let's take a look what we have here. We have, where's trade and other payables note? There it is. We have had at the end of last year 1,700 Rand that we owed SARS. We know that it's not that SARS owes us, because then it would be in trade and other receivables. But this is in the trade and other payables, which means we owe SARS, or owed SARS. At the end of this year, we owe SARS 3,600. So we are going to take our total tax for the year. We're going to add 1,700, and we're going to minus 3,600. Let's look at that in the note 4 to the cash flow statement. Let's go down to note 4. Taxation paid. Amount owing at the end of the previous year, 1,700. We paid that, so it's an outflow of cash, and that's why it goes in the cash flow statement. The statement of comprehensive income amount, that is total tax for this year, 45,600, minus the amount of tax that we did not pay from this amount that we still owe at the end of the year. Amount owing at end of current year, 3,600. So, the total amount of tax we paid is 43,700. Now let's take that 43,700 and put it in our cash flow statement. There it is, 43,700 in the cash flow statement under tax paid. We can now finally calculate our cash flows from operating activities. We sum these four figures and we get 39,000. That is, we had a net cash inflow of 39,000 Rand from operating activities. Now that we have that, we can forget about cash flows from operating activities for the time being. We can now move on to the shorter calculations, which are cash flows from investing activities and cash flows from financing activities. Let's just make sure we still have sound here. Yes, it seems that we do. Good. So, cash flows from investing activities. Investing in a business means putting money into assets that will generate you an income. For example, if you are a trucking company, you will maybe buy more trucks, or maybe you'll sell some trucks, right? So there are three things you can have here. You can have a cash flow from the purchase of non-current assets. You can have a cash flow from the disposal of or sale of non-current assets, which are here, proceeds of sale of non-current assets. That's listed here. And you can have changes in or what's it called? Fixed deposit. Changes in fixed deposit, which we do not have in this list. Now, we can have it in a cash flow statement, but it's not in this one. So, let's go back to our textbook, our question paper. We're going to look for changes in we're going to look for purchases, so cash outflows from purchases of vehicles. Let's go to our fixed assets, or purchases, sorry, not of vehicles, of fixed assets. So it could be vehicles, could be equipment, could be land and buildings. Our land and buildings went up by 150 minus 85, that is 65. It went up by 65,000. Our equipment went up by, oh no, actually we're going to have to do a little bit of a calculation here, because we had equipment going up. Oh no, but there was nothing going down. It says no fixed assets were sold during the year. Yay, so we don't have to worry about that. We only have to look at these figures and see how much did the equipment change. That's how much we bought. 181,500 minus 87,500, which is 94,000, I think. 94,000. So we have 65,000 increase in land and buildings, 94,000 increase in equipment. So together, in fixed assets increased. We purchased fixed assets of, if my calculations are correct, 159,000. Let's check it here. Purchase of non-current assets, 65,000. That's our change in land and buildings. Plus 94,000. That's our change in equipment. And that gives us a cash outflow of 159,000 Rand. Under the line item proceeds of sale of non-current assets, well, it tells us in the information here that no fixed assets were sold during the year. So it's zero, nothing. Which means our total cash flows from investing activities was 159,000 Rand. An outflow, total outflow. All right, now we've done the cash flows from operating activities, the cash flows from investing activities. Now let's do the cash flows from financing activities. Let's just check we still have sound. Yes, we do. So cash flow from financing activities. Here we go. let's go to our question paper here. So financing activities are activities used to raise funds for the business. Those activities are shares, that is either either issuing or repurchasing shares, and loan, that is either taking a loan or repaying a loan. And so you see these in 3 lines. You could have one line for issue of new shares. You could have another line for repurchase of shares, and you can have a third line for changes in loan. So increase or decrease in loan. So let's see first if there's a change in loan. That's an easy one. So we're going to go to our non-current liabilities. There was a loan change. It went from here's a loan from Shifty Lenders from 60,000 to 100,000. So we had an increase in the loans of 40,000 Rand. Now, would an increase in a loan be a cash inflow or a cash outflow? Well, we are getting cash from Shifty Lenders. So this is a cash inflow. So we don't put it in brackets. Now let's see if we repurchased any shares. Let's go to our what are we looking at here? Oh, I've gone blank. How do we see if we had repurchase of shares? I guess it would be ordinary share capital changed. Okay, we would see it in the ordinary share capital note, but there is no ordinary share capital note here. There is only ordinary share capital, which means we can assume that there is not repurchase and sale of shares. There's only sale of shares. If there were sale of shares and repurchase of shares, they would give us that extra information. So, ordinary share capital went from 108,000 to 200,000, which means we had an increase of ordinary share capital of 92,000. Now, would that be a cash inflow or cash outflow? Well, we sold shares, so we got money in for selling those shares, so it's a cash inflow. So that too will not be in brackets. Let's go to our marking guidelines. Proceeds from issues of share capital, there's our 92,000 Rand cash inflow. Proceeds from long-term loan, there's 40,000 increase in loan amount, that is a cash inflow, and a total cash inflow from financing activities of 132,000. Now before we continue, let's do a quick analysis here. Cash flow from operating activities is a positive cash flow, 39,000 Rand. See this one here? I'm going to use a different color for this. It's 39,000. It's a positive cash flow. Do we want cash flows from operating activities to be positive or negative? We want it to be positive. If it's negative, it means the business is operating at a loss and it is not sustainable. If things don't change, the business will fail. This cash flow from operating activities of 39,000 is not very good. It's not enough. So if you had to interpret these figures, you could say it is positive, which is good, but it's low, so they need to try to increase it, maybe by doing advertising or some other creative way of increasing their profits, perhaps new products in their product line, etc. So now let's look at the next one. Cash flows from investing activities. Investing activities was an outflow of cash. Now, do we want our cash flows from investing activities to be an inflow of cash or an outflow of cash? We want it to be an outflow of cash because you want to grow your business, which means you want to invest in your business. For example, if you are a trucking company, you want to be buying more trucks. That means your business is expanding. If, as a trucking company, you are selling more trucks than you're buying, that will tell investors that your business is shrinking. It's contracting. You are investing less in the business. Why would the trucking company want to decrease their number of trucks unless the business isn't doing well? So, cash flows from investing activities, you want it to be an outflow. How about cash flows from financing activities? Well, I guess it depends. It's a decision that the directors need to make. Do they want to, are they wanting to expand the business? Start new projects, or are they having cash flow issues? In which case, you would want the cash flows from financing activities to be positive. Okay, now we have our 3 cash flows. Let's see what happens when we add those together. 39,000 minus, so here's the 39,000. 39,000 minus 159,000 plus 132,000 gives us a total net change in cash and cash equivalents of 12,000 Rand. There's our magic figure. Now we need to also get that same figure if we work bottom up. That is, by looking at our cash and cash equivalents at the beginning of the year and our cash and cash equivalents at the end of the year. We also have to fill in the movements of cash and cash equivalents in Note 2 to the cash flow statement. Let's go to Note 2 now. Here it is, cash and cash equivalents. Let's go to our information. We will look at our balance sheet because that's where we see our assets. Cash and cash equivalents. We had an increase in bank of this amount, no change at all in our cash float, and an increase in our petty cash. Let's look at how we would put that in our cash and cash equivalents note to the cash flow statement. There is our increase in bank, and we write the figure under net change. No change in cash float, so there's nothing written here under net change. An increase in petty cash, there is the net change. And we can total each column. And we can see that it was 27,000 at the beginning of the financial year, 39,000 at the end of the financial year, so we had a net change of cash and cash equivalents of 12,000 Rand. And we can write those figures here. 27,000 at the beginning, 39 at the end, and the change is 12,000 Rand. And so we have arrived at the same figure by doing the top down and the bottom up way. And in doing these calculations, we also filled in all of our notes to the cash flow statement. We filled in our reconciliation note, this one over here. We filled in our cash and cash equivalents note. We filled in our dividends paid note and our taxation paid note. So we have filled in all this information and we have completed the cash flow statement. That is the end of task 3.42. I hope that it has been helpful. It's quite a long video, I know, 39 minutes, but I think it was necessary and beneficial. So, thank you and see you next time.